Hi there. My name is Simon Browning, and I'm a mortgage agent level 2 with Bricks Mortgage. I work with homeowners across the GTA. In this short video, I'll walk through one strategy that applies to a lot of homeowners right now and that many never actually run the numbers on. If you are carrying credit card debt, a line of credit, or a car loan while also sitting on equity in your home, this is for you. Give me the next few minutes and you'll know whether this applies to your situation. Here's the pattern that I see regularly. Someone owns a home, they built real equity in it, whether they've tracked it closely or not, and at the same time they're carrying debt outside the mortgage. Credit cards, a line of credit, car loan maybe. The monthly payments on that debt are real, and the balances aren't moving no matter how much they keep paying. The equity sits and grows in the house. The debt sits on separate statements. In many people's minds, those are two unrelated things, but they're not. Credit card and line of credit rates are dramatically higher than mortgage rates. When you're paying the minimum on a credit card at 19 point something percent, most of that payment is going to interest, not principal. That's why the balance barely moves, even when you feel like you're staying on top of it. This can catch people off guard because the math isn't obvious month to month. It only becomes obvious when you really sit down and look at it. Let's use a real example. Let's say you own your home with a mortgage of $490,000 at 4.2%. That's a good rate and you're happy with it. But you're also carrying $60,000 in other debt, maybe $45,000 on credit cards at 19.99% and another $15,000 on a line of credit at 10.5%. That debt blends out to roughly 17.5%. Just the interest on that $60,000 of debt is about $875 a month. That's before a single dollar goes towards paying it down. So you got a good mortgage rate on one side and expensive debt on the other. Many people will treat those as two separate things, but they're not. Now you might say to yourself, but my mortgage rate is good. Why would I touch it? Well, that's a good question, and it's the right one to ask. So let's actually look at it. Your mortgage rate is 4.2%, but that's not actually the rate that you're paying because you're not only carrying that mortgage, you're also carrying that $60,000 in debt at other rates. When you add everything you owe together, your real blended rate isn't 4.2%, it's about 5.66%. And that's the number that actually matters. So your mortgage at 490 at 4.2 plus $60,000 of debt on credit cards, that real blended rate across everything, 5.66%. Total interest of about $2,600 a month. So what does consolidating do? Well, that's where we fold the debt into the mortgage and refinance the whole thing at a new rate. Let's say it's around 4.6%. So now you got one mortgage of $550,000 at 4.6%. You got a new blended rate of 4.6%, and your total interest is only now about $2,100 a month. Your blended rate has dropped from 5.66% to 4.6%. Your monthly interest goes from about $2,600 a month to $2,100 a month. That's roughly $500 a month back in your pocket that you don't need to pay or that you could use to pay down that principal faster or even just for breathing room. It's about $6,000 a year. Here's the part that trips people up in the best way. Your headline mortgage rate went up from 4.2 to 4.6, but your real cost dropped more than a full point because you eliminated that expensive debt that was dragging the whole thing higher. So what actually happens to your mortgage? Well, your mortgage balance does go up by the amount that you're consolidating. Your mortgage payment increases slightly to reflect that, but your total monthly outgoing payments, your mortgage plus all the other debt payments combined, goes down because you've eliminated those high interest payments entirely. There's a second benefit to this that's easy to miss. That debt is now amortized. It's on a schedule to actually be paid off instead of sitting on a card indefinitely at a minimum payment that barely dents it. So when does this make sense and when doesn't it? Well, it's likely worth exploring if you have equity of at least $100,000 accessible in your home. If you're carrying $20,000 or more in high interest debt, and if the monthly payments feel like they're not really moving the needle. You also need to have stable income to qualify for the new mortgage amount. It's worth a second look before moving forward if the penalty to break the mortgage is too high. The savings need to outweigh the costs, and the only way to know that for sure is to run the numbers. It's also worth looking at closely if you've done this before and the debt has reappeared again. This strategy solves the interest rate issue, but not a spending pattern issue. I'd rather tell you honestly if the math doesn't work for your situation than have you assume that it will. That's what a consultation is for. So what happens next? If what I've described sounds like your situation, the next step is a 30-minute phone call. We'll look at your specific numbers, your current debt, your rate, your mortgage balance, and your renewal date, and we'll calculate exactly what a consolidation could look like for you, what your new payment could be, what you'd free up monthly, and whether it makes sense, given where you are in your mortgage term. No cost to have the conversation and no obligation. If the numbers work, we move forward. If they don't, I will tell you directly. To set up that call, please click the link below this video. Thank you for taking the time today. If this is the right move for you, let's run your numbers and find out.